Hello everybody, welcome back to my channel. Ascendas REIT announced their first half 2022 numbers, and I thought it was a extremely strong set of numbers. So you can see over here, voila! For existing investors, I think it's quite a very well performing set of numbers from their properties. So there are three things to like, and I give you a thumbs up. DPU is up, balance sheet is very strong, and the reversions was complete wow. But before that, something I noticed just now that the Ascendas REIT is celebrating 20 years of listing. So I dug up a bit of history, and apparently 20 years ago in 2002, this fella IPO'd at 88 cents. Wow, 88 cents. So the share price right now is probably around $3, right? So wow, in 20 years time, this is the capital appreciation, right? And along the way you collect dividends, right? So pretty good sell performance from this 20-year-old REIT. So the key highlights was very impressive. I think the DPU is up 2.8%, so it's now 7.87 cents. So if you annualize it, it's quite pretty much near what they used to achieve a couple of years back. The valuation is up 4.4%. The very impressive number I thought was the portfolio rental reversion numbers, 9.4%. Very impressive, right? Amidst current economic performances. So we'll talk about all three numbers later on. Of course, also the leverage and the balance sheet strength. So this is the DPU situation, as you can see the DPU improvement. So they explain it over here about the full contributions from the acquisitions and so on and so forth. But I thought the better way to look at it is to dig up the history. So see, you're comparing the first half of 2022 with first half of 2021. So for first half of 2021, you can see that the is from January to June, right? And for that period, the data centers was acquired only in the middle, right? And this stuff, Fusionopolis, was acquired right at the end, right? And these two acquisitions were very big in size, right? This is 900 million, this is 500 million. So this 1.4 billion acquisition didn't contribute much in the first half of 21. And obviously they contributed a full 6 months in 2022. So that's a big jump, right? Coming from full contributions from this stuff. And of course, they have acquisition in November as well in Kansas for logistics property. So they're really buying a bunch of stuff everywhere. Suburban parks in Australia, data centers in Europe, business spaces in Singapore, logistics in the US. And subsequently this year, they also bought some more logistics in the US. But this stuff is going to be balanced out by the divestments here and there, right? So by and large, the improvement this year in performance is due to full contributions from all these acquisitions last year. So I think that's the better way to think about it actually. But that's not just all, because rental reversions were also positive, right? So there's a mixture of inorganic growth through acquisitions and organic growth through rental reversions. So next up, we should look at the balance sheet, because as you know, the Fed is raising rates and the market is in a huge panic and selling REITs like bananas. But actually, there's not a whole lot to be worried about for this guy. So leverage is still pretty manageable at 37%. So actually that's quite low, right? If you compare it to S-REIT standards nowadays, it's like 38 to 40% already. In general, the S-REIT space has been creeping up in terms of their leverage. And if you look at the fixed debt, about 80%, right? Well, so pretty much only 20% left as a floating rate. What I think is quite nice is that they give you the sensitivity analysis. So if they raise rates by 1%, you're looking at maybe a 2% drop, right? Well, it's not that crazy, right? Given the the DPU rental reversions rates that you're experiencing. So I think it's quite manageable. So what's very impressive is the debt maturity profile. So look at it, the stuff here is crazy, right? You have debt going out 10 years out. So the debt maturity profile is one of the longest, I think, in the S-REIT space. Because actually, if they want to, they can give you the higher DPU by lumping all the debt in the short term, right? But they chose to space out everything nicely. So they see you don't have a column which is more than 1 billion, right? So there's no real panic if there's a credit crunch and the banks refuse loan, right? So this is quite rare to see. Debt going out the 10 years. So as for the asset portfolio, I thought it was very, very impressive. Look at it on a portfolio basis. Every quarter it's been going up, right? From 91% to 92 and now 94 across all geographies. And more importantly in Singapore, right? Because by and large, this is still a very Singapore-based portfolio. Of course, with diversification nowadays, especially over the past 3 years. But this is still a big portfolio, right? 3 million square meters in space out of 5.2 million. So you can see the occupancy rate also creeping up, right? 88 to 90 and 92. But this is mostly due to acquisitions and the new developments that they completed recently. What is really, really impressive, at least to me, right, is the rental reversions. So the headline number is 13.2% on the on the portfolio. So the average rental for the second quarter is 13.2. On a half year basis, it's 9.4. So look at it, it's pretty much a healthy reversions across all geographies as well, right? So it's not just increase in occupancies for all geographies, it's also uptick in rental reversions for all geographies. So this is the organic growth part, right? And you throw in the inorganic growth part from the acquisitions, so you can understand why the DPU really performed this year, right? So what's quite impressive is this number over here in Singapore. So you can see that the reversions have been quite flat, in line with GDP growth rate, right? So you look at the GDP for Singapore, it's like a 4% right? 4% up and down, right? Somewhere there. So for the first last 2 quarters, it's been following the GDP rate somewhat, right? But all of a sudden you have this big jump in the business spaces, life sciences, space, and also logistics space, right? So I think you can understand logistics because of the e-commerce and the supply chain disruptions effect. But this stuff was quite a bit of a surprise. 20% rental reversions in this space. So I think the tech guys and the life sciences guys are really ramping up, right? So it's a bit of a two-tier economy in Singapore, right? You have industrials and stuff, and then you have the logistics performing better, and then the life sciences and the tech guys are really growing. The other regions are quite in line with last few quarters. So you saw all these numbers in Australia and US performing in the last few quarters. So it wasn't a big surprise. Bit of a slowdown in the US. I'm not sure if it's because of a pending recession or maybe just a bit of a profile issue. But I think this was quite interesting in the UK and Europe situation where you have 12% rental increment, and it's all coming from data centers, right? Which is why I was interested, because they only finished acquiring the data center portfolio in last year, March last year. So actually there wasn't any numbers available for the last few quarters. And I was wondering how this portfolio was doing, right? Because if you look at it, it was quite a strange acquisition for this REIT, right? All along you think of it as an industrial space, and then it went to business parks, but all of a sudden you have data centers, right? So I was quite interested to see how the acquisition actually panned out. So it turned out quite nice, right? I was struggling to understand why there was such strong numbers. So I went to take out the presentation slides for the acquisition. So if you look at the acquisition slides, this was from last year. You can see that the this stuff in green were the ones that were expiring last year and this year. So this was the stuff that were contributing to the rental reversion, right? So because they are green, therefore you can see it's a multi-tenanted, right? Meaning to say that this were co-location data centers, I think. So you can see that the rental reversions for these guys were actually quite healthy at 12%. So that's I think quite an indication of the data center demand for co-location services in Europe quite nicely. Given that the co-location assets is 37% of the data center portfolio that they bought. So if dynamics remain where they are, and the rental reversions were indeed coming from the co-location assets, then for the next a couple of years, maybe this year and a bit next year and a bit over here, there's a bit of a potential for uplifts in the rental rates. So it really depends what happens in Europe and data and stuff. But nonetheless, 63% is still on the powered shell. So those were in blue, right? Because this was single tenanted. So there's a form of stability over here. And then there's some potential for rental reversions, I think. I wish they would give more data for the data centers, given that it's a new acquisition of a new asset class, and they probably could communicate to the market and investing community better on the how this stuff is playing out. But nonetheless, I think quite impressive. So overall, I thought it was a very, very strong set of numbers. In fact, I can't really find anything to fault the result announcement. So if I were to just force myself to think of two downsides, it will be number one, the potential for acquisitions going forward. Because if you look at the past 2 or 3 years, this REIT has really done a lot of acquisitions. And I thought it was quite smartly done. Because the share price was so high, it really makes sense to do a bunch of equity raising to fund accretive acquisitions. And now you have a pretty low gearing to do debt funded acquisitions in the midst of this rising interest rate, right? But one thing to note is the NPI yield for the assets that they're acquiring though. So last year when they bought the logistics properties in Chicago, it was already a low 5 handle kind of yield. So I'm not sure what's gonna happen to the yield on the new assets in this new environment of rising rates everywhere. So there wasn't much mention of the cap rates for the targeted acquisitions. At least none in the presentation slides, I think. So I think that's one thing that is a question. What's gonna happen to the acquisition path for the next 1 or 2 years, given this new dynamic of rising interest rates and somewhat lower REIT prices, right? So the cost of purchasing things is going to go higher. So there's a bit of compression of the spreads, right? So the second thing which I thought was more important was the situation in Europe, of course. So unless you are living in Mars, you probably know that Ukraine is in invasion mode by the Russians, and you can see the effect they have on the European gas prices, right? Went from like 40 a year ago to now 200, right? And as we approach the winter season, I think the demand is gonna really spike up, right? So what's gonna happen if the Russians really shut off the gas supplies to Europe? It's gonna be Armageddon, right? Because especially with this guy, so actually I think Ascendas REIT is one of the fewer REITs with exposure in Europe, at least amongst the big cap. I mean, there are some European focused REITs like AREIT and Cromwell, I think. But this guy actually has a decent exposure in Europe, right? So what's going to happen if the Russians really turn the screw on Europe and send gas prices up? Because if gas goes up, electricity is going to be in short supply, and if you have data centers and you have industrial properties and business parks, all of them need electricity, right? So what's going to happen when there's no electricity to or little electrical supplies? How deep the recession would be in Europe, and what kind of fragmentation would happen if credit spreads blow out due to the peripheral concerns. So I think this is actually the bigger concern for me, the situation in Europe due to the war, than the fears of rate hikes and stuff and recession fears in the US. So that's quite a fair bit to chew on, but overall a very good set of results, I think. So we've reached the end of this video. If you like what you saw, then remember to subscribe, like, comment, and share. Until next time.